I hate to upset everybody, but yields on the 10-year do not accurately reflect current inflationary conditions, nor do they predict future inflationary predictions, nor do they even do a good job at reflecting yesterday's inflationary conditions. They don't reflect expectations. They are not to be used as a tool to predict inflation. It doesn't work. Hasn't
Fine.
worked
Then
in
look at the
70
tips market,
years.
Josh. The tips market has not made a new high in a few months. I mean, you look at the material sector, look at transports, look at any of the cyclical. A lot of those that have been trading in line with inflation are telling you the opposite. Not just the bond, not just the 10-year yield.
They trade in line with inflation sometimes, and then they trade out of whack with inflation because a data point comes out that they don't react to the way people think they should. And then everyone says, ooh, maybe there's more to the story. There's not. It's buying and selling in the marketplace. Supply and demand are too big for us to look at any of these instruments and say that they're a thermometer for current or future inflation. It just doesn't work. It hasn't worked in 7 decades. The evidence is the evidence. So I understand that we all want there to be some symmetry between how bond yields are reacting to the day-to-day news on the economy. It really doesn't work that well. And I don't think, more importantly than any of that, Sarah, I don't think investors should drive themselves crazy changing their own expectations or moving around pieces in their portfolio based on the prevailing yields on the 10-year. Think about how much demand there is for a positive yielding risk-free rate of return anywhere on Earth. There's so much demand coming from so many sources that you've got this permanent distortion in place in the yield or in the price. So I don't really think that this is a useful exercise. It's an interesting observation to make. It's not helping anyone. It hasn't been accurate in so long that I can't believe we're still talking about it that way.
Well, hold on, Josh. We still had that demand when yields went from 50 basis points to 175 over a few months, and everybody's saying, look, it's the reopening trade. It's because we have reflation. It's because, and it fit exactly in with what sectors were working during that period.
In the stocks or in the yields? Which one do you want to do first?
In the stock. No.
The
yields had their move despite all the standing demand. And we had banks and industrials and materials ripping over that period of time.
Okay, and in the last 30 days, we've seen probably 10 or 20% of that unwind. Is that because we think that for some reason the reopening has stopped? No. What's really going on is that investors using their dollars have voted, meaning decided what assets they want to own, and they've had their fill. That doesn't tell us an accurate story about where we think things are going from now. This is just about how people feel today. So I do agree with you. There's a correlation between value/cyclical segments of the market and inflation expectations. But where I get lost is this idea that on a daily basis, the 10-year is going to serve as a weather vane for either the growth in the economy or the rise of prices or whatever. It's just not going to work that neatly. And again, it really never has.
Maybe not daily, but it's made quite a move here.
Shepard Smith here. Thanks for watching CNBC on YouTube.